Hello, everyone, and welcome to the next episode of the Retirement Tax Services Podcast, Financial Professionals Edition. I'm your host, Stephen Jarvis, CPA, and I am joined this week by a fellow CPA, Brad Wooten. Brad, welcome to the show.
Thanks, Stephen. Glad to be here. Looking forward to it.
Yeah, absolutely. It's always, for me at least, I mean, maybe just guilty pleasures here of having a podcast. I love being able to have fellow tax professionals on to kind of talk shop and to give advisors a little behind the scenes on what getting all this work done looks like. So before we dive into kind of the main part of what we're going to talk about, give just a little bit of background to the audience of kind of what it is you do, who you specialize in serving.
Yeah. So I opened up my tax firm in 2019. So this was my sixth tax season, and I focus mostly on small business and individual tax returns. So I do predominantly S corporation tax returns for professional service business owners, and then pretty much any individual tax return, as long as they don't get too crazy and like the cold wallet crypto stuff or, day trading or anything like that. I handle the majority of my practice is 1040 tax returns.
Yeah.
And then I do about 40 S corporations.
I do appreciate that you throw in the caveats there. Hey, there's a few things I'm just not going to do. I'm the same way. International tax makes that list for me as well. Like if you're going to get into international tax, you need to find someone who does that all day, every day. Like that's a pretty focused area. So, Brad, the biggest thing I wanted to talk about today, I mean, we're a couple months removed from the big, beautiful bill getting passed. I've talked about it several times on the podcast. I'm sure advisors are sick of hearing the kind of checklists of here's the planning opportunities with the big, beautiful bill. What I don't think it's talked about often enough is what a tax law change like this will mean for tax professionals. And the reason I think this is important to advisors is all of your clients work with some kind of tax professional. Even if they DIY, then they're their own tax professional, and that's its own kind of scary at times. But there is somebody in your client's life who has to prepare a tax return, and that gets a lot more convoluted and complicated when we have a major tax law change. So, Brad, we say here in September as this airs, I mean, kind of like what are you anticipating for this coming filing season? How different do you think it's going to look compared to last year?
Yeah. So as I anticipated, I'll be honest, I haven't done enough thinking about anticipating this as I should have. But one of the huge benefits is, hey, we got a tax bill in the middle of the year. When was the last time that happened? I forget, Stephen, when you started. I started in 2008, and that was when we were getting these like 1-year patches on December 31st every year, I think, of the Bush tax cuts. And I was like, hey, let's patch it for a year. Are they going to do it this year or are they not? So, the fact that we got this in July instead of December is huge, so that we can at least start to take the continuing education on this, get up to speed on this, start to educate the clients on this. And that is just something I'm very thankful for, as opposed to December or, good grief, the year that they were like, hey, we're not going to tax unemployment benefits. And they did that after we had already filed returns. That was the first time I'd ever experienced something changing after we had already filed it. And that was a pain. So very grateful for that. Honestly, what I'm anticipating most is, of course, there's going to be some changes in the forms, right? So, when I don't know if many people remember this, but unless my memory is wrong, I'm pretty sure Obama was the first president to talk about a postcard-sized tax return. And then Trump started talking about it too. And we got the shortened 1040. And what came with that, right? Was schedules 1 through 5. Because if you take stuff off the front of the tax return, you got to put it somewhere. So we simplified the first 2 pages and created 5 new schedules. So there's definitely going to be new schedules, right? I don't know if they're going to squeeze some of this stuff into current schedules. The problem with that, though, is like, oh man, which one? Is it schedule 1, page 2 that has the above the line deductions? Where you can't stick some of these new deductions in there because they're not above the line deductions.
Above the line, yeah.
They more flow into where like QBI is. So they're not going to be able to go onto that schedule. They're going to have their own schedule. So new schedules. Will they monkey around with the main 2 pages of the 1040 so that when I'm comparing year to year, I've got to jump around and wonder what was in that versus this? So definitely probably a little bit more inefficient on the reviewing of the returns. And then, the biggest thing, just questions from clients, right? Why this? Why that? I don't understand this. What changed? Things like that. So going to be a lot of time spent communicating with clients.
Well, and that's such an important point right there, Brad, for advisors listening, because I promise this podcast is not meant as a desperate cry for advisors to help all the CPAs in the world. That's a nice side benefit. What advisors take away from this really should be, how do I help my clients' tax experience be better this year? Because so much what an advisor does has a tax consequence, and I've talked about it plenty of times on the podcast. But being on the tax preparer side, if I don't know about something until March or April, and I don't have a relationship with the advisor, which thankfully in my case isn't how that works, but it's not surprising that a lot of CPAs will say, "Oh, well, your advisor did these three things that screwed it up, and they never told me about it, and so it's their fault." It's like it's not a shock why advisors get thrown under the bus. And so, I mean, some context, kind of building on what you were saying there, Brad, that advisors probably aren't aware of. On a normal year where there aren't major tax law changes, the tax software we use will release the new forms for us in like the middle of January, because that's when the IRS finally gets around to releasing the new forms. And that's when there are minor changes, like it's 2024 instead of 2023, and the tax rates changed a little bit. On a year where there's major changes like this year, geez, I don't even know what to begin to guess as to when those forms will be available. And again, the reason I'm sharing that context is because while I'm with you, Brad, I love that we have more time to process how the bill should work in theory. We have more time to have conversations about what kind of the planning is. There is still the very real implementation and execution piece. There's still the very real possibility that everything we thought about one of the provisions in the bill will look a little bit different when we have an actual form to file it on. It's possible that a form will come out and be incorrect or create an unintended consequence. And so this tax filing season will get very compressed very quickly.
Yeah, that's 100% true. And, again, I mentioned the July piece for us. Well, hopefully, right? I mean, I use UltraTax by Thomson Reuters. I certainly hope that they have a team that's already on trying to do this. But how much can they do before the forms with the instructions are released? To your point, they can't even start the programming until they get that. And then there's pieces to this too, where we just from the tax law may have one line item. Well, then we might get Treasury regulations, and we might get Q&As, and we're going to get the IRS interpretation of this. And there's plenty of things in this bill where it could go in a couple of different directions depending on how the IRS interprets this. And we got to wait and see before we even know how to advise on that fully.
Yeah, well, I mean, let's take a recent example that's still being implemented, Secure 2.0. I mean, we're a few years into that. There's still provisions of Secure 2.0 that are becoming effective this next year, so don't forget about that. But when Secure 2.0 first came out, at least as I recollect it now, kind of one of the big sticking points was, okay, inherited IRAs got shortened to a 10-year time frame to distribute everything. And then it went pretty sharply back and forth of, at first it's like, oh, and there's no RMD requirement. And then it's, wait a second. There might be an RMD requirement. And then it's, oh, in certain situations, there's definitely an RMD requirement. But there were multiple I'll use very sarcastic air quotes, but there were definitive answers that kept changing. And so, Brad, you're absolutely right. And so one of the takeaways I'd love for advisors to have from this is, with the tax law changes, it actually becomes even more important than in other years that you are really dialed in on the kind of recurring, what maybe feels like basic things. The more you can do to help your clients understand the planning you did with them for the year so that they can communicate it effectively to their tax preparer, the better able the tax preparer is going to be to navigate these changes and have a quality outcome for your clients. Because if you're thinking, hey, I'll wait till February and then I'll remind the CPA that we did a Roth conversion. In February, the CPA is going to think about a few different things. Your Roth conversion is not going to be top of the list.
Yeah. Another big piece of this too that I think about is, think about all the clients. I feel like probably the majority of my clients. So again, I have clients from 50,000 up to, I'm not doing ultra high net worth clients, right? I'm doing your typical average American. And I would say that for a large portion of these folks, they're not going to see much change.
Mm-hmm. Yep.
And so I think one of the biggest questions we're going to get is, hey, didn't this massive tax bill lower my taxes and save me a bunch of money? Why am I paying the same amount as last year? And the reason for that is because this tax bill wasn't, hey, here's an extra $10. It was, hey, we were going to take $10 more from you, but we decided not to. And people aren't going to notice that as much as they notice, here's an extra $10.
Yeah, Brad, I really appreciate you bringing that up. That's been high on my mind as well. And I like the $10 analogy because that's exactly what's going to happen. Because the headlines that people heard was major tax law change, tax rates got lowered. It's going to create trillions of dollars of more debt, of more national debt. Like these are the buzzwords they heard. And so I'm with you. There's a lot of people, the financial advisors typically work with people making hundreds of thousands of dollars a year even they're not going to see a dramatic change.
Yeah.
And some of them are going to be confused. Some of them are going to be disappointed. For there's so many people who, to your point, won't be dramatically impacted in a way that they're going to see. If you did a side by side comparison of what 2025, 2026 would have looked like without the changes, then it's a little bit more of a stark contrast. But I think there's going to be a lot of taxpayers who are like, wait a second, where was my big tax break from this tax law change?
Yeah. Yeah, exactly. Because it's not coming, right? They've got the same tax brackets. QBI is the same. There's, the roughly the same child tax credit. I mean, everything mostly stayed the same for a huge chunk. And I haven't done a deep analysis on this, but I would say, okay, if you've got people from $150,000 married filing joint, $150,000 to 400, they're going to kind of walk away feeling the same. If they're under 150 and they get this new senior deduction, or they get tips deduction, or they get overtime deduction, the child tax credit gets a little bit of a bump, they're going to feel more. The standard deduction got a bump. So the sub 150 married filing joints, sub 100, they're probably going to walk away better off and actually maybe feel it, as opposed to it kind of staying the same. The 150 to 400, maybe they're going to stay kind of the same because they're going to phase out of some of this new deduction stuff, right? Like the senior deduction, they're going to phase out of. And then your 400 plus, they got some new stuff, but also they're going to phase out of some of this other stuff that's up coming into play. QBI is going to stay the same. Their itemized deductions are going to start phasing out if they're in the top tax bracket, which, this is when I realized I was getting a little too old, Steve. When I was on LinkedIn, and some CPA, I ended up looking, I think he was 3 to 4 years in.
Yeah.
And, he said, I've never seen them limit itemized deductions before. And I commented, I was like, what about the P's limitation? And I don't know if it's P's or piece, but I've only ever read it. I've never said it out loud. I started in 2008, and I didn't realize that was, what's that, 17 years ago. You don't think about that, right? You just think like 2008, that was not that long ago. And so I said, well, what about, the P's limitation? And his response was, he's like, oh, Brad, I should have known you were going to come back with some weird, quirky stat about, like the tax law. And I was like, weird, quirky stat? Like, this was common everyday talking point in 2008, 2009, 2010. I was like, this is not some weird, little known fact about the tax code. In fact, I think we had it. Did TCJA do away with that? Like, or was it before that? I don't remember, but I know we had it in 2010. And this bill made that permanent, right? The P's limitation is gone permanently. So, it was going to come back, which is why I think it was TCJA that did away with it. But they've got this new, and I haven't read this one in detail enough, but it's this new 237th, phase out. And that I think only applies if you're in the 37% tax bracket. But I haven't dug into that one in too much detail.
Yeah, I mean, itemized deductions have changed so many times in how they work, and now, we've got different phase outs. We've got the potential deduction of automobile loan interest. We've got a floor getting added to charitable giving. Like there's all these. We've got the SALT cap change, which if people hadn't already assumed that Brad was in an income tax free state because that hadn't come up yet, Brad's based in Florida, which I do love income tax free states. Because there's some people, but to your point, it's only people in a certain range just before that, because that starts phasing out.
SALT cap's going to phase all the way back down to 10,000. So for the people paying the most in state income taxes, they're going to get stuck with the 10,000 anyway, right? Because they're high income. So I think it starts I don't know when it starts. I want to say it's around 400 or 500 for married filing joint. It's going to start to phase out. And you think about, okay, even at a 10% tax at 400, when it starts to phase out, that's when you're going to get the 40. Now, of course, you got your property taxes added to that too. So I do think there's going to be a lot of people in your normal, 5-6% state income tax states that between their property taxes and their state income tax, they're looking at $30,000 there that they've been limited to 10. And so that's gonna help people significantly that are in that space. Even some that weren't itemizing at all because maybe their charitable giving is pretty low. And so it's like the mortgage interest of 15 plus a capped, 10 was leaving them with the standard deduction. But now that state income tax plus the property taxes, could push that up. Yeah, there's going to be a lot more itemizing. There's going to be a lot more itemizing in general.
And Brad, I think that just reinforces the point that you were making, that for a lot of people, it's not going to be as a dramatic of a change as they probably are anticipating, because the way this bill got talked about was, huge tax cuts, and here's how much it's adding to the deficit, or how much they're cutting out of the budget, or they're all these huge numbers got thrown around, which I'm still convinced that no one actually knows what $1 trillion is. Like we say that like we know what that means. I have no concept of what $1 trillion is. Right. But if somebody tells me that a tax bill is going to cost $4 trillion over 10 years, like, heck yeah, I think I'm going to get a big piece of that. Until you dig into it, and you're like, oh, I'm going to get none of that, or very little of that. Not in a way that's going to change from 2024.
Except, again, my QBI is not being phased out yet. Maybe one day it will be because of the SSTB, the Specified Service Trader Business stuff, but it's not yet. And, so I'm sitting there looking at the tax brackets, and I've been bunching my charitable giving to itemize every other year, and the QBI. And so, I know that because of this tax bill, I'm saving $6,000, $7,000, $8,000 in taxes.
Yeah.
But I'm staying where I was.
Yeah.
Again, coming back to, I'm staying where I was. Your
tax bill's not going to drop by $6,000 or $7,000.
No, it was going to go up, and now it's not. Yeah. So I'm thankful for that. Yeah. And so the average taxpayer is not going to realize that until we tell them like it was going to go up, but it didn't.
Yeah, so especially for advisors who, a lot of people are listening to this, they're either into their fall planning meetings with clients or getting ready for them. This is something to definitely be aware of, because even for the clients who work with a great CPA, for advisors listening who work with RTS, of course we talk to our clients about tax planning and tax law changes, but those clients are still going to come to you in your meetings when you're talking about financial planning, and they're going to say, wait, how did this thing apply to me? What do I need to do different? How much money am I going to save this year because taxes went down? And you're, like Brad's articulating here, you're going to have to explain to clients that it's not that you're going to see this dramatic drop in your tax bill. For most taxpayers, you're just not going to see the significant increase that otherwise would have been there.
Yeah. And I think for financial advisors, at least the ones that I talk to, maybe we can talk about the Social Security, the tax-free Social Security. So we'll go there. But first a quirky thing that I just thought about the other day, and it just is an example of some of the interplay with the new bill, because there's a lot of new stuff tied to AGI, right? A lot of these new deductions tied to AGI. That's why they can't be above the line deductions, reducing AGI, because then it would be a circular calculation. So there's a lot of that. There's a lot of, you have to have a valid Social Security number. So if you work with resident aliens, or I don't work a lot with folks without valid Social Security numbers, but I know that there's a lot of examples there where there's going to be people losing out on some of these things because they have I-10s instead of valid Social Security numbers. So just pay attention to that. But this piece, take a married filing joint couple who's got some property taxes, some mortgage interest, and let's call it $5,000 of charitable giving. And I'm going to round down to make it easy. Standard deduction, $30,000 in 2025, right? So let's say they land at $31,000. So in the past, you would say, hey, 31,000 itemized deductions beats the standard deduction. We're going to itemize at 31,000. But if you choose to not itemize, your standard deduction is 30, and you get this new non-itemizer charitable deduction of 2,000. So now you're at 32,000. And instead of just this very simple, do we itemize or not? Now you got to look and say, oh, crud. Well, if itemized doesn't beat the standard by at least 2,000 and they have 2,000 in charitable giving, we need to flip the script on that and go back to the standard, even though itemized deductions are technically higher.
Yeah, Brad, that's an interesting point. I'm glad you bring it up there, because one of the things we got to remember about taxes is that taxes are so much more emotional than money in general, because almost guaranteed there's advisors listening who think, Oh, but in your example, we're talking about a couple $100 in taxes. Like nobody cares, and you're wrong. They do care. Clients
Yeah,
care
the guy making $1 million, I guarantee you he cares about that $200. I've talked to him.
in taxes, especially when it's taxes.
Yeah.
He might have lost $200 last week out of his wallet and not cared at all.
Right.
An extra $200 going to the IRS makes everybody mad, regardless of their political affiliation. I work with clients across the political spectrum. They all want to pay less in taxes personally. They just have different opinions about how much somebody else should pay. And so these things do matter. And you don't want to be the professional in your client's life who didn't ask the questions and who didn't bring up the opportunity. Because if someone else comes, it's such an easy way to lose trust of a client if someone else brings up an opportunity you never mentioned.
Yeah. Which, okay, before we go to the Social Security benefits, one more is, okay, because you bring that up, right? So do you, we all know, right? There's no way that you can get a dollar for dollar savings in taxes where, hey, I'm going to put $4,000 in my IRA and I save $4,000. Okay, it doesn't work that way, right? It's always going to save you less in taxes than what you come out of pocket.
Yeah.
Well, there's this new scholarship granting organization's charitable tax credit.
Mm-hmm.
And so $1,700 that you can get a dollar for dollar tax credit if you, now again, you're giving up the $1,700 to this nonprofit charitable scholarship granting organization. But if you can give the $1,700 to someone who's going to scholarship a kid to a K through 12 school instead of giving it to the U.S. government, I'm researching scholarship granting organizations because I'm going to take the $1,700 is coming out of my pocket. It's just, is it going to go to the government or is it going to go to someone who's going to give a kid a scholarship to go to school? I'm giving it to the organization that's going to scholarship the kid, So that's a huge benefit for those. And again, $1,700 to someone making $1 million, $2 million, they don't care, but they'd rather it go there than to the U.S. government. So you better bring that one up to them because that's going to be one where they're going to be like, you mean I could have dollar for dollar shifted my money to something I believe more in? You should have told me about that one.
Yeah, absolutely. I've got a client who, because Arizona has some provisions and has for years with charitable giving where you can get a credit for
and you got to back those out, right? You got to back those out of the federal credit.
Yeah. From what I the federal credit, but on the state level, basically, instead of paying taxes to the state government, you can pay taxes or you can give that same money to certain charities. So I have clients every year who they wait until the end. And then they say, okay, here's how much I'll give to the charity. So
yeah,
but we keep getting off topic here. Let's talk about tax-free Social Security, Brad.
Yeah. So tax-free Social Security. So I got that email. I think I got it at 1:30 a.m. I don't know who at the Social Security Administration was sending out emails at 1:30 a.m. I think Trump tweets at 1:30 a.m. Well, not anymore, right? But I think he posts at 1:30 a.m. Maybe it came from him. But yeah, I got the email and it said something about like 90% of Social Security benefits will no longer be taxed, and then there was a lot of that. I won't get political or anything because I don't really know. But a lot of that email could have been favorably interpreted, right? Like, okay, in practically speaking, 90% of these Social Security benefits will no longer be taxed because of this completely separate deduction. But then there was a line in there that said, additionally, there's a $6,000 deduction for seniors. And I was like, well, okay, there's no additionally because they did not change the taxability. So that's the thing here. So if, again, I know that financial advisors get a lot of questions about Social Security. When should I take Social Security? How do I maximize my Social Security? At what age should I be? Should I delay it? Should I take the money and invest it? How's it taxed, right? So, from 0 all the way up to 85% of this can be taxed. That does not change at all. So the way that you calculate your taxable portion of Social Security is identical, and the taxable amount of your Social Security is going to be the exact same. Now, I don't know enough about the political process, but I read that under the type of bill they passed, right? They only needed a simple majority because of the process that they used to pass this bill. Under that type of process, you cannot touch Social Security. So they weren't able to change the taxability of Social Security because of the process, apparently. So what they did was they kind of did this, well, let's just give old people, right? Let's give seniors a new deduction because most of them will be on Social Security. So at the end of the day, it's kind of like Social Security is not taxed anymore. But the question you get, though, is, okay, you don't have to be drawing Social Security to get this deduction. You can be 68, you can be delaying your Social Security to, what, 70, 71, and still get this $6,000 deduction. And if you're married filing joint, it's 12. It's 6 each. So yeah, you don't have to be taking Social Security to get it. It's not tied to Social Security. Your Social Security line item on your tax return, if you've got those detail-oriented clients, they're going to look at it and go, whoa, why is my Social Security still in this taxable column? And it's because they didn't change that.
Yeah, I appreciate you bringing that one up, because when that's one we have to remind ourselves that our clients don't spend as much time listening to podcasts and being on LinkedIn and the internet as all the rest of us financial professionals. So for the people paying attention, that email came out. There was this kind of like, wait a second, Social Security is not really going to tax free, is it? And then everyone's like, no. Here's where the confusion was, and we all moved on. But you're still going to have a lot of clients going into the year having only seen that one email and thinking, heck yeah, tax-free Social Security, because that was also a really common headline along with tax-free tips and overtime. And so it just another area where there's going to be plenty of confusion and a great opportunity to, again, change the outcome for the client. Because if you proactively have a conversation in the fall that says, hey, Bob and Sue, I know there's been a lot of confusion flying around with this new tax law change. Here's a couple of things I want to clarify about your situation. Breaking the bad news then of, hey, Social Security is still taxable, here's what it's going to look like, is much different than them being surprised by a tax bill. Because once they have the tax return in front of them and it says, hey, you owe this much, or your refund's the exact same it was last year, that's when this stronger emotion set in. And it's a little bit harder to kind of claw that back. So we want to stay ahead of this as often as we can.
Yeah. I mean, not related to this bill, but I just replied to a client about an hour before this podcast recording where he looked at his tax return and he goes, hey, Brad, my AGI only went up by 20%, but my taxes went up by 48%. This doesn't make any sense to me. And so, he's calculating the percentages of how much his tax went up year over year versus his AGI. And again, smart guy, understands his taxes well enough to be going through the tax return. But I mean, it's just like, okay, hey, your taxes aren't calculated on your AGI. Yeah. They're calculated on your taxable income, and your itemized deductions also went down. So taxable income went up by more than 20%. Yeah. And then, oh, hey, by the way, 10,000 of that last year was long-term capital gains. And so this year it's not long-term capital gains. So you also have, same amount of income, but last year part of it was long-term capital gains. This year it's ordinary income. That's going to increase your taxes too. So we'll see what he replies to that, but it wasn't adding up in his head. And so hopefully that explanation will help it add up. But it's going to be the same thing, right? It's going to be the same thing with this. I thought this. It's not what I'm seeing on my tax return. Please explain it to me.
Yep. And the more ahead of the game we can be on that, the better the client experience is going to be. So,
yeah.
Brad, I appreciate you taking the time to have the conversation. For people listening who want to learn more about what you're doing, how can they find you?
Yeah, best place to find me, I would say, is LinkedIn. So Brad Wooten, CPA on LinkedIn. You can go to my website too, wootencpa.com. And we do take on new clients. We're selective, like most people are right now. But I always say, reach out to me, and I'll let you know if I can do it or not. It's always a no if you don't ask, right? So you might as well ask.
Yeah, that is definitely the truth. Well, take the time to follow Brad on LinkedIn. He's a great follow. I'm connected with him out there. And like I said, Brad, really appreciate you being here. For everyone listening, until next time, good luck out there. And remember to tip your server, not the IRS.